On Friday, June 12th, 2026, Elon Musk made history. Because the moment SpaceX began trading on the Nasdaq, Musk became the first human being ever worth more than $1 trillion. 5 revelations explain what that number really means, from paper wealth illusions to a tax code under siege. Some of these will challenge everything you assume. It starts with the day Wall Street changed forever. Number 1. The SpaceX IPO shock on June 12, 2026 marked a turning point not just for Elon Musk, but for the entire conversation around modern wealth. Before diving in, a brief disclaimer. This video is for educational purposes only, and it does not provide financial or tax advice. Viewers should always consult a qualified professional about their own situation. On that Friday morning, SpaceX began trading on the Nasdaq under the ticker SPCX. According to major news reports, the company raised approximately $75 billion in its initial public offering, instantly becoming the largest IPO in United States history. Shares were priced at $135 each, but investor demand sent the opening price up to $150. By the end of the first trading day, the stock closed just under $161, a 19% gain that pushed SpaceX's market capitalization to about $2.1 trillion. This extraordinary surge had a direct impact on Elon Musk's personal net worth. Forbes and Reuters both reported that, on paper, Musk's fortune soared to roughly $1.1 trillion, making him the first person ever to cross the $1 trillion threshold. At that moment, Musk was worth more than the next 4 or 5 richest individuals combined. The milestone was celebrated with a bell-ringing ceremony at Nasdaq's market site in New York, while Musk himself appeared via video from SpaceX's Starbase in Texas. The sheer scale of these numbers is almost impossible to grasp. For context, Musk's net worth at that moment represented nearly 4% of the entire United States economy. But the headline figure tells only part of the story. The rest of this documentary will break down what a $1 trillion fortune actually means, how much of it is real money versus paper wealth, and why the tax code treats these gains so differently from ordinary income. In second place, the concept of paper wealth stands at the heart of Elon Musk's $1 trillion headline. This is a crucial distinction for understanding what it really means to be the world's richest person. Before going further, a brief reminder: this segment is for educational purposes only and should not be taken as personal financial or tax advice. Always consult a licensed professional about your own situation. According to major news reports and financial analysts, the vast majority of Musk's fortune is not sitting in a bank account. It exists almost entirely as shares of Tesla and SpaceX, whose value has soared on the open market. These shares represent what is known as unrealized gains, wealth that exists on paper but has not actually been turned into cash. A useful analogy is a valuable painting hanging on the wall. It might be worth millions, but unless you sell it, you cannot spend that money. The same is true for stock. Until Musk sells his shares, that wealth remains locked away, fluctuating with every tick of the market. If Musk tried to sell a large portion of his holdings all at once, the sudden flood of shares could drive the price down, shrinking the overall value of his remaining stake. And any shares he does sell would trigger capital gains taxes on the profit, turning paper wealth into a taxable event. This is why, despite a net worth that once topped $1.1 trillion after the SpaceX IPO, Musk has described himself as cash poor in public statements. The difference between net worth and liquid assets is more than an accounting detail. It is a fundamental part of how fortunes like Musk's are built and maintained in the modern era. Understanding this gap is essential before exploring the mechanics of taxes and borrowing that follow. Number 3. The buy, borrow, die strategy reveals how paper wealth can be transformed into real spending power without triggering a typical tax bill. Before going further, a brief reminder: this segment is for educational purposes only and should not be taken as financial or tax advice. Always consult a licensed professional about your own situation. This approach starts with buying or holding assets that grow in value, like shares of Tesla or SpaceX. Instead of selling those shares and realizing a taxable gain, ultra-wealthy individuals borrow against them. According to Tesla's SEC filings, Elon Musk pledged about 92 million Tesla shares as collateral for personal loans. With shares valued in the tens of billions, this collateral allows for enormous borrowing capacity, all while keeping full ownership of the stock. The money borrowed from the bank is not treated as income by the IRS. It is a loan, not a paycheck or a stock sale. That means no capital gains tax is due at the time of borrowing. Interest is paid on the loan, but the underlying shares remain untouched. This structure is legal and widely used among the ultra-wealthy. It lets someone like Musk access cash for personal spending, real estate, or even philanthropy without ever having to sell a single share. The final piece comes at the end of life. Under current law, when these assets are passed to heirs, the step up in basis resets the tax cost to the market value at the time of death. In practical terms, all the unrealized gains that built a fortune can disappear from the tax ledger. This system is not about criminal avoidance, but about how the tax code is written. It is why major news outlets and congressional hearings have focused on the buy, borrow, die approach as a central feature of modern wealth planning. For someone with a fortune built on paper, this strategy turns stock-based value into spendable cash, while minimizing tax exposure, all within the boundaries of United States law. Number 4. The real tax picture reframes the debate around Elon Musk's tax record with hard numbers instead of speculation. This segment is for educational purposes only and does not provide financial or tax advice. Viewers should consult a licensed professional for guidance on their own situation. According to ProPublica's investigation of leaked IRS records, Musk paid $0 in federal income tax for the year 2018, despite his wealth growing by billions on paper. Over the 5-year span from 2014 to 2018, ProPublica calculated his true tax rate at just 3.27%, far below the rate most Americans pay on regular income. These headlines have fueled criticism, but the story does not end there. In 2021, Musk publicly announced he would pay over $11 billion in federal taxes, a figure confirmed by major news outlets and rooted in his exercise of Tesla stock options that were about to expire. That single-year payment stands as one of the largest individual tax bills in US history. The reason for these dramatic swings is rooted in the mechanics of the tax code. Wealth built through rising stock prices is not taxed until shares are sold or options are exercised. This means years of rapid paper gains can result in minimal tax, followed by a sudden spike when a taxable event finally occurs. Musk's record shows that federal income tax for the ultra-wealthy is not a flat line, but a series of peaks and valleys tied to when and how gains are realized. Number 5. The big debate over whether the US tax code still works in the era of trillionaires moves the story from mechanics to policy. According to major news reports, SpaceX finished last year with a net loss of nearly $5 billion, despite generating more than $18 billion in revenue. The majority of that revenue came from Starlink, the company's satellite internet business, raising questions among analysts about whether the company's $2 trillion valuation is truly justified or just another example of paper wealth outpacing financial reality. These numbers fuel a deeper civic conversation. Is a tax code designed for millionaires and billionaires still fit for a world where someone can amass a $1 trillion fortune on paper? Critics argue that the current system acts as a loophole, allowing the ultra-wealthy to avoid paying income tax on unrealized gains, wealth that exists only on paper until shares are sold. They point to strategies like borrowing against stock holdings and a step up in basis at death, as ways fortunes can grow, be spent, and even transferred to heirs with minimal tax. Supporters counter that these are legal tools available to any investor or business owner, and that taxing unrealized gains could discourage investment and innovation. Both sides agree that the stakes are higher than ever, as the gap between paper wealth and tax paid by the richest Americans has never been wider. The rise of the trillionaire has turned a technical debate about tax mechanics into a national question about fairness, incentives, and the future of the US tax system. This documentary is for educational purposes only, not financial or tax advice. Across every fact, one pattern stands out. Fortunes like Musk's are mostly on paper, not cash in the bank. According to SEC filings and major news outlets, that distinction shapes the real debate over wealth and taxes in America today. Subscribe to TaxCode for more.